Welcome to this week's version of Nickels and Dimes, our weekly video series. While the markets continue to be challenging, it looks like this bear market does not want to find a bottom. So odds favor, at least based on the trend, we're heading lower. June 15th was the low, at least in this bear market. We had a bit of a rally up 23% since that time, and we've seen another downturn. It looks like we are breaking those lows. So brace yourself if you're not hedged or protected. Well, today I want to talk a little bit about a pretty standard portfolio known as the 60-40 portfolio that many folks, if you're conservative or moderate, you tend to have some kind of mix of a 60-40 portfolio. And it struggled this year. Historically, it's done pretty well, but this year it has struggled. So we're going to take a little look at the return year to date and how a 60-40 portfolio has performed over the last some years, and what tends to happen when the 60-40 portfolio underperforms. So let's dive in. So a little basic 101, and I'm sure you know this, 60-40 portfolio, which really means 60% of the portfolio is equity-based, so it could be individual stocks, or maybe it's stock-based or equity-based mutual funds, and that 40% is bond funds or individual bonds. That could be corporate bonds, it could be muni bonds. But generically, a 60-40 portfolio is what many people have, at least historically, created or diversified to get a reasonable return over time. Now, the goal per Vanguard of the 60-40 portfolio is to average around 7% annually. Well, the good news is it's actually done better, at least looking at a Vanguard study from 1926. It's actually averaged around 8.8%. Well, how have things done? How have we done with a 60-40 portfolio year to date? Well, as of September 15th of 2022, it's down over 20%. And actually, at the time of this recording, it's likely down a little bit more. Well, if you look historically since 2008, really, this is one of the worst years on record, if not the worst years. Again, as we noted, the 60-40 portfolio since the 20s has averaged a little over 8%, with the goal being 7%. So you could see in most years, it's done pretty well, up 15%, a few years ago. And even, as it recovered after the 2008, 2009, 2010 years, it was up 16 and 10. But again, the goal here is really to reduce your risk by diversifying and get a reasonable return over time. Well, there was a study done by Edward Macquarie, the professor emeritus at Santa Clara University, that looked at what happened after past bad years of the 60-40 portfolio. And he noted that all years since 1793, the 60-40 portfolio, after a bad year over the next 5 years, averaged a 7.2% return. So that's good news. But when the 60-40 portfolio fell by at least 20%, which again, we're in that range right now, the subsequent average annual return over the next 5 years is 13%. So that's good news when studying market history. Now, here's what I would say. I would caution, because, looking at a study like this, at one point in time and assuming that the past will equal the future, I would caution you, because what we've seen, as you recall, at least over the last 30 years, we've seen a consistent decline in interest rates. And as you know, interest rates are inversely correlated to bond values. So 30 years of by and large downtrending interest rates have propped up bond values. And again, we've been on a very solid bull run on the equity markets for many years, which really stopped earlier this year, and even looking at the fall of last year. So even though the 60-40 portfolio is struggling year to date and is unfortunately having one of its worst years on record, historically it has tended to recover the following year. Again, this does not mean we don't have further downside. This does not mean in 2023 that things won't get more challenging for the 60-40 portfolio. But again, looking at market history, looking at the study of tendencies, the market tends to rhyme, or asset classes tend to rhyme. So if you're in a 60-40 portfolio or some mix of this type of allocation, at least looking at a study like this by the gentleman from Santa Clara University, maybe it gives you a little bit of confidence, again, if your portfolio is down. Now, at the time of this recording, the S&P is down over 20% year to date. The NASDAQ's down over 30%. And the average bond portfolio, depending on how long you're going out, could be down from anywhere from 5 to even 20% if you're looking at the long bond. Things are challenging. You see, the markets continuing to be volatile. So again, if you have a 60-40 portfolio, you're likely in some level of pain. Will it get worse? Odds favor, at least looking at the way the market is reacting right now, odds favor things will get more challenging. Again, particularly if we break and stay below those June 15th lows. All that to say is, if you would like a second opinion on your portfolio or financial situation, just go on our website at nicholswealth.com. In the upper right-hand tab where you see this Contact Us tab, you can click on that, fill out the information, and then one of our advisors will get to you to answer your questions and hopefully provide you some clarity. Thanks again for watching. Bye-bye.